Jomo Kwame Sundaram of the United Nations Department of Economic and Social Affairs. Jomo, you have 10 minutes.
Thank you very much to George Soros and to Rob Johnson for inviting me to participate in this meeting. The challenge of dealing with this topic is, of course, compounded by the fact that I did not know what was going to be presented in at least a couple of cases before I heard it today. But let me try to pose the problem in terms of the larger context of the debate which we are having this weekend. I think the central debate, looking at it particularly from the perspective of developing countries or emerging economies, as we are often referred to these days, is that of the challenge of financial globalization. And I think the discussion so far has already made clear that a number of the claims of the proponents of financial globalization have not been realized, and in fact the converse has been true. Firstly, as we have heard several times yesterday and today, there has been a net flow of funds from the capital poor to the capital rich. And there have been, of course, important exceptions to some of the emerging market economies, episodic, but this has generally been the norm. Secondly, we also know that the cost of funds did not decline because of greater financial globalization. They declined mainly because of policy rates which were set by the US Fed, among others. And thirdly, we also know that while some of the old sources of volatility and instability were reduced, we have seen significantly new sources of volatility introduced. Part of this is what is referred to popularly as hot money, the hot money flows which have had huge impacts and disproportionate impacts, as Andy Haldane's presentation has quite correctly emphasized. And this really raises a very important question about whether we should characterize the period before the crisis as one of the great moderation. But let me move on very quickly, since the title of this session implies that that there has been a significant period of globalization, and this is often not disputed. We often think of globalization principally in terms of trade integration. And this graph basically suggests that the degree of financial integration has actually been, financial integration has grown much faster than trade integration. Now, all this has resulted, as we have heard, in a great deal of flow of resources from the developing countries to the richer countries. And I think it is important for us to put in perspective what Professor Marin raised about FDI in this context. It is true that FDI has principally flowed from the rich countries to the developing countries, but if we look at the numbers on FDI, of what is termed FDI, or what is categorized as FDI, in the 1990s, for instance, more than 80% of what is termed FDI consists of brownfield FDIs, principally for mergers and acquisitions. Less than 20% actually went to greenfield investments in the sense of investing in new economic capacity. Secondly, I think FDI flows are notoriously pro-cyclical, and this exacerbates many of the problems which we have been talking about over the weekend. Thirdly, much of the FDI flows has been concentrated in a few investor darling countries. The most prominent emerging market economies, many of whom are in East Asia, and a number of others in other parts of the world. Fourthly, I think it's important to recognize that the inflow of greenfield FDI often means the marginalization of the possibility of the development of domestic capacities and capabilities. And this is not to be underestimated. And in this respect, I would, for example, contrast my own region, Southeast Asia, with Northeast Asia, where there has been there has been much more development of industrial capacities. And as far as Africa is concerned, I think we all know that most African FDI has been concentrated in mineral and natural resource exploitation and in very little else. If we move on and to consider who has been receiving the totality of capital flows, we find that the US has actually been the recipient of half the total capital flows during the recent period. Let me point out that as far as developing countries are concerned, the inflows of capital, when they have occurred, have been hugely problematic. They've often contributed to bubbles and subsequent busts. They've often contributed to consumer binges and in episodes of overinvestment in certain areas. And as we know, many emerging market economies currently are facing problems of Dutch disease as well as the huge costs associated with what is often referred to as sterilization. Now, we also know that all this has involved a great deal of financial fragility, but since there are other discussions of Minsky and all that, I won't get into all that right now. But we also, with some degree of recovery, we do know that global imbalances are beginning to widen again. Now, okay, since I'm running out of time, let me skip over the next few slides. We can do some multitasking. You read the slides while I'll talk about something else. Now, I think one of the questions which Jumin, who's here today, raised at Davos in January is worthy of revisiting, and that's the whole question of the growth of inequality. Now, it's important for us to recognize that inequality is often perceived and discussed as inequality within countries, but there has been also a corresponding growth of inequality among countries which we need to think about. Secondly, we often talk about inequality in terms of interpersonal or inter-household inequality. But the functional distribution of income and the inequality of the functional distribution of income, I think, merits a great deal of attention. And if we look at where money has been going, and particularly to the FIRE sector, finance, insurance, and real estate, it raises some very important issues. Now, let me move finally to the last point. Okay. I seem to be missing one slide. Okay. What are the national reform priorities? Because I think, as we hear from Gordon Brown and many others over the weekend, the possibilities of reform are principally at the national level. And let me highlight three issues. The first issue, of course, is the whole question of need for prudential risk management, including capital controls. Now, this is provided for by Article 6 of the IMF's Articles of Agreement, and we need to take this extremely seriously. There's a discussion going on right now as we speak, and we should continue next week on the whole question of capital controls, which we need to revisit and which I don't have time to elaborate on right now. It's also important for us to try to think very systemically about building in counter-cyclicality into our reform efforts. Thirdly, of course, to ensure that we are able to more adequately finance growth and development as well as employment expansion. And the other point which is important in this regard, of course, is the whole question of financial inclusion. Financial inclusion has been very narrowly associated with things like microcredit and so on, but there's a need for a much a broader discussion of financial inclusion. And in a sense, it's ironic that this crisis is often associated with the subprime mortgage market segment, which was in a sense an attempt or involved a certain degree of financial inclusion, and this is one of the very important matters. Finally, if I may make one last point, since I've not had a chance to say anything about the last presentation on corporate social responsibility, we at the United Nations have a very major challenge. We initiated something which is called the Global Compact, and Anne Zamet, who is here in the audience, has done a very important critique of the Global Compact in terms of the possibilities of blue wash and what it implies in terms of corporate social responsibility. Thank you.